Hey, my name is Blake Wiswell, and welcome back to Beyond the Ticker. If you caught our last video, Stocks 101, you already know how owning a piece of a company works. Today, we're flipping the script. One thing before we jump in, this is an AI avatar of me. Beyond the Ticker runs on real expertise delivered in a new way. Now let's get into it. Instead of owning a piece of something, what if you could lend money and get paid for it? That's exactly what a bond is. And by the end of this video, you're going to understand why bonds are one of the most fundamental tools in investing. Let's get into it. Let's go back to that coffee shop from last time. You've got a thriving business, you want to expand, and you need capital. Last time, we talked about selling shares, bringing in owners. But there's another option. What if instead of selling ownership, you just borrowed the money? You go to an investor and say, lend me $10,000. I'll pay you back in 5 years, plus interest every year while you wait. The investor gets steady payments, you keep full control of the business, everyone wins. That agreement, that IOU, is a bond. Now let's talk about how this works in the real world. Bonds aren't just for coffee shops. Governments, cities, and massive corporations issue bonds all the time to fund roads, buildings, operations, you name it. When you buy a bond, 3 things matter. The face value, that's the amount you'll get back when the bond matures, usually $1,000. The coupon rate, that's the interest rate the issuer pays you. Say it's 5%. That's $50 a year, every year, just for holding it. The maturity date. That's when you get your face value or principal back. Could be 2 years, 10 years, 30 years. So you lend $1,000, collect $50 a year, and get your $1,000 back at the end. Simple. Now here's where it gets interesting, and this trips a lot of people up. Bond prices and interest rates move in opposite directions. When interest rates go up, existing bond prices typically go down. When rates fall, bond prices rise. Why does that happen, you might ask? Think about it this way. You're holding a bond paying 5%. Then interest rates jump to 7%. All of a sudden, nobody wants your 5% bond. They can get 7% somewhere else. So the price of your bond drops to make it competitive. That's the market doing its job. This is one reason bonds are more nuanced than they look, and why understanding them is a real edge. So who issues bonds? 3 main categories. The US government. These are called treasuries. T-bills, T-notes, T-bonds. They're considered the safest bonds in the world because the US government backs them. Municipal governments. Cities and states issue these to fund public projects. A big perk, and something you can bring up in a conversation with your advisor. The interest is often tax-free. Corporations. Companies issue bonds too, and they typically pay higher interest rates than governments because they carry more risk. The higher the risk, the higher the reward. Now, the last thing I wanted to mention about bonds. Not every bond is created equal. Rating agencies like Moody's and S&P grade bonds the same way a teacher grades a paper. AAA is the gold standard. Super safe, lower yield. As you move down the scale, the risk goes up, and so does the interest rate to compensate. Bonds rated below a certain threshold are typically called junk bonds. Higher potential return, but you're taking on real default risk. So how does this fit into your overall strategy? Most investors use bonds to balance their portfolio. Stocks can be volatile. They swing up and down. Bonds tend to be steadier, generating consistent income. That balance is the foundation of modern portfolio theory investing, a topic we will likely cover in an upcoming video. That's the traditional view of bonds, and we will go deeper into explaining different wrappers you can buy them in. But what we're really going to be digging into on this channel is what happens when you start thinking beyond the safety net. More on that very soon. But for now, That's Bonds 101. You know what a bond is, how pricing works, who issues them, and how they fit into the bigger picture. If this helped, like the video and hit subscribe. We're building something here at Beyond the Ticker, and we're excited to have you with us. We'll see you soon. Hey!